Hello class and welcome to our today's lesson. Today's lesson, we are going to talk about the bank reconciliation statement. Having looked at the cash book, in the cash book, we talked about a case whereby we have got the cash column, which normally records all the cash transactions, whereby on the receipt side, we have a column whereby all the cash that is received is recorded in that particular column. On the other side, which is the payment side, we have got also another cash column that records all the cash payments that are made in a particular period. Similarly, we also have the bank column on the receipt side and the bank column on the payment side. The bank column on the receipt side records all checks that are received in a particular financial period. And on the payment side, the bank column records all the checks that are issued in a particular accounting period. Our concern here will be on the bank columns. Here you should note that if the business has got a bank account where it deposits its checks and also makes payments through the checks and they are effected in the bank, then the bank column of the cash book and the document that is prepared by the bank, which is known as the bank statement, they should actually capture the same information. If all the checks that are received are recorded in the cash book, and all those checks that are received are taken to the bank for payment, so they should be appearing in the cash book on the receipt side and also in our bank statement as money that was received. The same case should apply when it comes to payment. If we have issued checks to our customers or to our suppliers, for that case, all the checks that are issued by the supplier, they are normally captured in the cash book. The same checks, they are taken by the suppliers to the bank for the payment to be effected, meaning that the bank will also record them in our bank statement. Therefore, at the end of the period, if everything is well recorded, the items that are appearing in the bank statement and the items that are appearing in the bank columns of the cash book, they should actually be identical. But more often than not, they are normally not identical, and you'll find that the cash book balance and the bank statement balance, they differ, yet they are supposed to be the same. So the bank reconciliation statement actually tries to explain why is the cash book balance bank column and the bank statement balance not the same, yet they are supposed to be the same. Therefore, worth noting is this. A bank reconciliation statement is prepared so that we can try to find out why is it the cash book balance, bank column, and the bank statement balance, they are not the same, yet they are supposed to be the same. So here, we try as much as possible to highlight reasons why they are not identical, yet they are supposed to be identical. So on an introductory part of it, from what you can be able to see on your screen, which is actually the notes that I've shared in our platform, is that a bank reconciliation statement explains the difference between balance reported in the bank statement and that reported in the cash book. But remember here in the cash book, our interest is only on the bank columns because that is where the identity should be. So the bank statement, which is actually a document that is normally prepared by the bank, is actually supposed to capture all the information the business has undertaken involving checks, which can be either deposits or withdrawals. Remember, withdrawals are the checks that we have issued and they are debited, whereas the deposits are the money that we have received or the checks that we have deposited in our bank account, meaning that our bank account is increasing. Now, we go to the most important area here, which is what are the reasons for differences in the bank statement balance and the cash book balance? These two reasons are actually like this. One, we are going to have items that are in the cash book but not appearing in the bank statement. Yes, these are the things the business is aware of, and they are appearing in our cash book or the business cash book. But when you go to the bank, those items are not there. Those items are not there because the bank is not aware whether they actually took place. These items, they are actually categorized into three. Number one, we have what we call the unpresented checks. Unpresented checks class, note that they are the checks issued by the business, meaning that these checks, they are meant for payments. They have been paid, and actually in the cash book they have been recorded by the accountant, but the person to whom this check was issued either delays or never takes that particular check to the bank. So the bank is not aware that that particular check was issued. So these checks, because they were issued by the business, the moment they were issued, the accountant recorded them in the cash book, but the person to whom the check was given did not take it to the bank by the time this particular bank statement was being prepared. So the cash book and the bank statement will not have these two things appearing in both. The other case is what we call the uncredited checks. Uncredited checks are the checks and deposits from customers. In short, these are the checks that have been received. The moment they have been received, they are recorded in the cash book, but because we are the business that received that particular check, we delay taking them to the bank, or we take them to the bank, but because checks normally take 2-3 days to be cleared, then you find that maybe in the first day, the bank statement is when it was being prepared, therefore they were not yet cleared to appear in the bank statement, but they are already in the cash book, meaning that this check or this amount has been captured in the receipt side of the cash book, but in the bank statement, the bank has not received or cleared that check to be also reflecting in the bank statement. Before I proceed, I want you to get it clear. Uncredited checks are the checks received, but they have not yet been captured in the bank statement. While unpresented checks are the checks issued, but they have not been taken or presented to the bank for payment. Crediting, remember, it is a case whereby the account is receiving money. That's why we call uncredited, or checks which have not been reflected in our bank account as receipts. Another case of items appearing in the cash book and not reflected in the bank statement, it is a case of errors in the cash book. Errors in the cash book. More often than not, the accountant might make some errors. Instead of writing 10,000, he writes maybe 1,000. Instead of writing maybe 20,000, he writes 200,000. That is a case whereby we can say the amounts have been overstated or understated. Also, you can find a case whereby misposted deposits and payments. Instead of writing it on the payment side in the cash book, you write it on the receipt side, and such kind of a scenario. At the end of the day, you'll find that these items that are only in the cash book but missing in the bank statement, or the errors that are in the cash book and in the bank statement, they are well recorded, they are going to create a difference. The cash book balance, bank column, and the bank statement balance, they are not going to be the same. Then we move to items number 2. Items number 2 are categorized as items appearing in the bank statement but not reflected in the cash book, meaning that they are in the bank statement, but when you try to locate them in the cash book, they are not to be seen. These items are as follows. We have something we call bank charges. These are actually the charges that are levied by the bank for having maintained your account. You will find that maybe if it is done monthly, the bank will just deduct it directly, and maybe the accountant is not aware also to capture it as a payment. We have got interest charges in case of loans and overdrafts. The bank will charge this interest from the amount that we have in the bank, but in the cash book, you find that maybe the accountant is not aware that that interest has already been deducted. We have got the direct debits. These are the payments that are made by the bank directly, and the accountant is not aware. We also have what we call the standing orders. Standing orders. In case the business is having a regular payments that it makes, it can go to the bank and instruct the bank to be making these payments on their behalf without necessarily the accountant appearing to the bank to effect them. If, for example, it is a loan that you pay maybe 5,000 per month for 10 months, you can go and instruct the bank to be doing so. Just at maybe the 10th day of each month, deduct maybe 5,000 from my account, deposit that amount in this account. That is what we call the standing order. So you'll find that these standing orders, when they are being effected, the accountant is not aware that the money has already been deducted, and therefore they are already in the cash book as payments. Sorry, they are in the bank statement as payments, but they are not captured in the cash book as payment. Then we also have a case of dishonored checks. These are checks that have been rejected by the bank because of quite a number of reasons. One, maybe the amount of the person who wrote the check is insufficient. Two, it can be a case whereby the amount in figures and words, they are not the same. It can be a case of post-dated or outdated checks. They may be, the check is not so clear, it's not legible, such kind of a case. So you find that once that check is taken to the bank does not accept it. And because of the moment it was received, it was recorded in the cash book. Once it goes there and it is rejected, then there is a need also to cancel it from the cash book so that these two statements can be identical. We have what we call direct credits. Crediting, remember, is a case whereby we are receiving money as a business. Direct credit is a case whereby the customer pays directly into our bank account without even notifying us. If I have your money and I have your bank details, I can go and deposit direct without even informing you. So you'll only notice that payment once you receive the bank statement. Then we have interest income or dividend income. If the business has made some investment in another company and that investment has earned some dividends, those dividends can be paid directly into the bank, and then the cash book will not be having them because the accountant is not aware. And also we have a case of errors that are occurring in the bank. Though they are rare, but in some cases they occur. Either the bank has over deposited or over withdrawn your account in some cases, which is quite rare. So at this particular moment, maybe we can talk about why is it important to prepare bank reconciliation statement. Number one is to update the cash book. Remember, we have talked about a case whereby items are in the bank statement, but they are not in the cash book. Because they are not in the cash book, then the cash book is not capturing all the necessary information. Once you have noticed that some items are missing, then you update the cash book by including those items that were supposed to be there, but missing. Number two is to correct and detect errors. The moment you get the statement from the bank and you realize it is not having the same balance as what you are having in the cash book, then there is likely a case of errors. Therefore, you can find how those errors occurred. We have a case of to record omissions, those items that are missing in either case, and to explain the difference in cash book balance and the bank statement balance. Once you have known that, we can go to the steps in preparing the bank reconciliation statements. Number one is to update the cash book. Once you have got the bank statement and you have your cash book, then the first step is to update the cash book. And how are you going to update the cash book? By including those items that are in the bank statement but missing the cash book. Remember, from the onset I've said the cash book and the bank statement, they are supposed to have similar transactions, similar records. Once you get them and you find that in the bank statement we have some items which are missing the cash book, then the cash book is not actually correct. Then we update it. And not at this particular juncture, the cash book is updated using items that are in the bank statement but not appearing in that cash book. Because they were supposed to be there and they are missing, then we update this cash book so that it can have all the necessary information. Number two, compare the debit side of the cash book with the credit side of the bank statement to determine uncredited deposits. Remember here, anytime we receive money in our bank account, we normally say our bank account has been credited. Therefore, in the cash book, remember, the debit side is where the receipts are recorded, but in the bank statement, it is credited. The credit side is where the deposits are actually captured. So when you compare the debit side and the credit side, you are simply comparing the receipts. In the cash book, receipts are debited, but in the bank statement, receipts are credited. Compare also the credit side of the cash book, which we normally call the payment, and the debit side to determine the unpresented. Again here, once the bank makes payment on your behalf, or once you write a check for a particular payment, we normally say your account has been debited. So a debit in the bank, it is the same as the credit in the cash book. Credit side of the cash book is the payment, while the debit side of the bank statement is for the payments. So the two will be compared to determine the unpresented checks. Remember, the unpresented checks, we said they are checks that have been paid by the business. Then after getting the uncredited and the unpresented checks, then you can go ahead and prepare the bank reconciliation statement. Note here, items that are in the bank statement but missing in the cash book, they are used to update the cash book. Then items that are on the debit side of the cash book but not on the credit side of the bank statement, they are known as uncredited checks. Items that are on the credit side of the cash book and the debit side of the bank statement, they are known as unpresented checks. The uncredited checks and unpresented checks, they are used to prepare the bank reconciliation statement. Why? Because they are already in the cash book. Now, where they are missing is in the bank account. So we reconcile using them. After noting that, I think it is high time I give you a highlight of the format for preparing the bank reconciliation statement. The bank reconciliation statement format, or formats, there are two. You have format one, whereby we start with the balance as per the updated cash book. Remember, we have updated the cash book. The moment we have updated the cash book, then the cash book balance that we are going to get is going to be known as the updated cash book balance. If you start with the balance as per the updated cash book, you add the unpresented checks that you have identified. If there is any error the bank has committed, this is not the error in the cash book, but the error in the bank. And these errors will reduce the bank balance in our account, e.g. overstated deposit. If that error was to increase the bank balance, then they are supposed to be added to the unpresented checks. Then you raise uncredited checks, also the errors which upon correction will increase the bank balance in that case. And then if you have the balance as per the updated cash book, you add unpresented and the errors that will reduce the bank balance, then you raise uncredited and the errors that will increase the bank. The two, you will find that you are going to get the balance as per the bank statement. We have got the format number two, and format number two is a case whereby now you start with the balance as per the bank statement. If you start by the balance as per the bank statement, you add uncredited checks and then you raise unpresented. And then it's actually like the opposite of the first format. There's an example that has been provided whereby you are given an extract of the cash book and an extract of the bank statement. So in that case, it was required that you prepare a bank reconciliation statement. Note here, what you simply do is this. You start by preparing updated cash book. How do you prepare the updated cash book here? The updated cash book here is prepared by looking at the items that are in the bank statement but missing in the cash book. And remember, the debit side of the cash book is compared with the credit side of the bank statement. So you look here and you determine that, like if you have a case like the debitor, don't focus on the balance brought forward. Look at these other items. Like here, you will find that there is this figure. There is this figure that was actually that 900 and that, yeah? 930 for Morris, which is actually on the credit side here. But if you look here, it is not anywhere to be captured. So because it is on the credit side, but missing on the debit, so that item is missing the cash book. So we write it here because it was supposed to be on the debit side. Then if you compare the credit side of the cash book and the debit side here, you realize this bank charges of 470, bank charges of 470 is actually missing. 470 is actually missing. If you look here, there is nowhere we are going to get the 470. So because it is missing the cash book, we include it. And remember, in the cash book is supposed to be on the credit side. Why? That's why it is here. At this moment, let me emphasize something. When you are comparing the credit here and the debit, leave alone the items that here are here but missing here. Just focus. Look, like for example, 1010. You come here. Is 1010 there? If it is there, then it's okay. 440, confirm whether 440 it is here, then it is okay. 930, it's not here. So this is the only item that is not in the cash book. So you include it on the debit side because it was supposed to be here on the debit side. Go to the credit side, compare here. Like for example, the credit side here, the debit and the credit here, you look here, 4620 is here. You look 210 is here. You look for 470, you come here, it is missing. So 470 was supposed to be on the credit side. That's why it is here on the credit side. Remember, we normally start with the balance brought forward. Anytime you are updating the cash book, this cash book balance of that 370, it is here. That 370, it is here. This was the cash book at the end of the year, but this balance, it is not correct. That's why it is appearing here. So this is the balance that we are updating. You use it here as the balance brought forward, and then you add what was missing on the debit, you minus what it is missing on the credit side. Upon getting that, now this was supposed to be the correct balance for the cash book, 34,830. This is actually what we normally call the balance as per the updated cash book. So when you come here, you realize it's going to be like this. The balance as per the updated cash book, which is here, 34,830. Then you add unpresented checks. How do you determine the unpresented checks? Unpresented checks are determined like this. Remember, they are in the cash book but missing here. So you look here, 1010 on the here, it is here. You look for 440 it is here. Then you go to Trish, that 190, it is not here. Then we have Smith, 2460, which is not here. Remember, these are actually the checks that are received, and the checks that are received are actually the uncredited checks. So the checks for Trish and Smith, they are supposed to be the uncredited checks because they are received, but they are not in the bank statement. So they are here as the uncredited. For the unpresented, you look for the payment side because we said the unpresented checks are the payments. The payments is here. So you'll find that Bob 4620, it is here. 210 is here. 470, you look for Tom 2090. When you come here, 2090 is not appearing. So this check that was paid to Tom, because this is the payment side, was not presented to the bank. And that's why when you come to the bank reconciliation statement, you will find that this check for Tom that was paid is actually not presented. That's why it is here. So 34,830, which is the balance, you add this, you get this figure, and then you raise this, you find that 31,270 as the balance as per the bank statement, and you can actually confirm whether your answer it is correct. You come here to the last figure in the bank statement, just go down the last figure there. That is the balance for the bank statement, which is actually the same as now. That's now what we normally say or call reconciliation. Thank you and enjoy your moments.